Well, hey there, everyone. Happy Monday, November 24th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a pretty classic fall day here in Redmond, Washington. Overcast, a little chilly, a little rainy. Life is good, though, and I hope you're all thankful for something wherever you're tuning in from. I appreciate you so much. I'm thankful for you guys being a part of Market Misbehavior, watching my content, asking questions, and making this a pretty entertaining way to spend my time. As a reminder, we welcome your questions. The comment section on our YouTube channel, always open and available. If anything that I'm showing you or sharing with you elicits some question in your mind, please take a moment and drop a comment with that question. We're planning an all mailbag episode on Friday. Is that true? Probably not this week. This week's going to be a different week. I'm so used to saying that, but this week, because of the Thanksgiving holiday, we'll be doing an adjusted schedule. No show on Friday because of the shortened holiday week. Planning a show today, Monday, and tomorrow, Tuesday. We'll probably take Wednesday off, but we'll be putting out a YouTube video. So please make sure, excuse me, you stay tuned for that. By the way, speaking of the markets today, nice recovery day after Thursday's absolute bloodbath, Friday's nice bounce. Open question was what happens today? We're getting a nice move higher. Volume not as strong as what we saw on Thursday and Friday, but the price action is pretty key with the Nasdaq Composite up 2.7%. Volatility coming down 3 points lower on the VIX almost. Nice update. The question for tomorrow and into Wednesday's shortened session, is there going to be enough momentum? And actually, fact check, pretty sure Wednesday's a full session, but Friday's the half session. With that in mind, let's get to the markets here. And I apologize, I'm still fighting a cold here, but doing my best to take it easy. The S&P 500 closing above 6,700. If you look at what happened today, the big move was in the morning session after around 1 p.m. Eastern. We pretty much just treaded water for the rest of the day, but a nice surge higher out of the open really helped this to be a pretty strong up day. So the S&P now has bounced off of our support. We talked about our line in the sand at 65.50. That line was in play Thursday and Friday of last week. Today, we're bouncing off of that level. So continuing that bounce off of support. As we mentioned last week on Thursday, as we sold off toward that level, pretty common to have a bounce off of a major and widely expected level of support. There will be a lot of dip buyers betting on that bounce to happen. The question usually in my mind is not, will we find support? That's almost a given. The question is what happens after. And this is why I think what happens Tuesday, Wednesday, probably into next week. Do we get a sustained advance off of that bounce of 65.50? Still a lot of question marks for this market, I would say. I'm not anywhere near any sort of all clear sign just yet in terms of the conditions that I'm observing. And I'll show you some charts that back that up here. But for what it's worth, note that the VIX went down almost 3 full VIX points, still above 20. So we're still in a high volatility environment. As we mentioned, right, in recent weeks, when the VIX is over 20, the way that you have to think about that is that's the options market telling you that the normal daily movements in the S&P are just going to be wider. When the VIX is below 20, you'd expect like little 0.5% up days, 0.5% down days. We had a lot of those on the way up from the April low up to the October peak. We've had plenty of sort of low volatility uptrends, which means not big up days, not big down days, just kind of a grind higher. With the VIX elevated here, that means we should get big up days and big down days, right? More volatility, and that's what the VIX is really measuring. The reason why that's such a negative thing is because big volatility usually happens more often in sell-offs than in market rallies, right? We kind of panic and sell. We panic and excess volatility usually implies the market's trending lower. Today, big percentage swing, but back to the upside, of course. Mid caps and small caps worth noting, both up. Both of those lag the S&P and the Nasdaq today. Looking at interest rates, you can see bond prices generally moved higher. The TLT closed just above $90, which is up about 0.6% from yesterday. The dollar was flat. Interest rates generally trending lower today. The 10-year yield's getting closer and closer to 4%. We included that chart last week on one of those days, sort of this, kind of consistent downtrend channel that we can draw on the chart of the 10-year treasury yield. That's $ TNX on stock charts. Rates have generally been trending lower, and so what that means is basically bonds are trending higher here. So we're in that situation where stocks are kind of in pullback question mark mode. Bond prices generally continuing to trend higher here. Looking at the commodity space, another really good day for gold and silver. The GLD up 1.6%, silver up 3%, 2.9%, we'll call it. Crude oil prices were higher, although energy stocks lagged today. Natural gas prices were pretty bad relative to other commodities. But I'm impressed by the nice uptrend move in gold and silver. I grabbed the chart of gold so we could talk about it a little bit. I mean, what's happened with the GLD and with spot gold is it's bounced off of a key support level and now sort of holding gains just above that support. And so overall, I would tend to think of that chart as constructive, as innocent until proven guilty. And I think breaking down below that level of support would be a really bad sign for gold. We're not seeing signs of that. It's worth noting here, chart of the GLD, kind of a nice open. It just continued higher through the course of the day today. Cryptocurrencies mounting a decent recovery here. Bitcoin, as you can see, on Sunday got down to just below 81,000. Today, we're seeing a surge higher. So equities moving higher along with, cryptocurrencies moving higher in line with equities having a decent up day as well. Bitcoin up about 2.5% to 89,000. Ether up 6.1% to 2970. You can see all 10 of the top coins tracked on the stock charts platform in the green today. And that, that's a good sign. I mean, generally speaking, that's a great sign because Bitcoin and Ethereum, I would say, and generally cryptocurrencies are a pretty good read on speculative pressures, right? I'm concerned when the S&P and the Nasdaq are moving higher and Bitcoin and Ethereum are tanking, which is what's happened, recently. And now today having a nice upsurge is good. I think, if Bitcoin can continue to recover, push above 90,000, that would be a great sign. Ideally above 100,000, which was a big round number that obviously broke earlier this month. Looking at the 11 S&P sectors, we have technology back to the top of the leaderboard, up 2.4%. A lot of these are semiconductor and other names, as we'll see on the heat map. Those all had really good up days, bouncing big time off of the sell-off last week. What's very interesting, though, the chart of NVIDIA still not going up. And if you look at earnings last week, we still haven't even made it out of that range from that earnings day or the day after earnings when the stock sold off on Thursday. I think that's a telling illustration of the challenge right now with the AI trade. Consumer discretionary, number 2, up 1.3%. Utilities, number 3, up 1.1%. On the downside, you can see only 2 of the S&P sectors were in the red. Consumer staples down 1.2%. Energy down about 1/3%. Real estate slightly above the zero level. Breadth wasn't bad today, actually, on the New York Stock Exchange. Fat finger there. On the New York Stock Exchange, about a 2-to-1 ratio, 60% higher, 37% lower, about the same on the Nasdaq. With the S&P was a little more even, 52% up to 48% down. But generally, this was an okay breadth day. It wasn't just technology working; plenty of things were up. So we could see 9 out of the 11 sectors were down. 2 out of every names on the NYSE were in the green. That's a pretty good day. The question, again, with this sort of move, with a day like today, is it sustainable, right? Do we see real signs of accumulation? I'm not seeing that yet. But again, that's what can happen. That's why we keep looking at the charts. That's why we don't put a trade on and then go do something else. We keep looking at the charts and waiting for that picture to evolve. Our market trend model, as we covered with our market misbehavior premium members over the weekend, we have a weekly flight plan, which is our main weekly report for premium members. If you want more info on the premium membership, by the way, we are running a Black Friday second chance sale. We had a Black Friday sale last week, had 10 slots. They filled up very, very quickly. So I made a second chance sale. Go to marketmisbehavior.com/premium. You can find all the information about our premium memberships, virtual courses, which you can access, our reports like our weekly flight plan and monthly chart review, and a member community where you can ask questions at any time. I'm in there every day, sharing ideas, answering questions, and helping people use technical analysis for their own benefit and for their portfolio's benefit. If you go there, marketmisbehavior.com/premium, make sure you use the code Ooh, what is the code? Hold on, I have to check because I forget what it is. I just said it. Man, I should write this stuff down. The code is SPX Dave, SPXDAVE. If you use that code, you'll get 40% off your first 12 months on any plan. We have a monthly membership and an annual membership. Make sure you check that one out. This is a great time to lock in 12 months of the premium membership at a greatly reduced rate for Black Friday. Marketmisbehavior.com/premium. Use the code SPXDAVE, SPXDave. By the way, as we were meant to get back to this, as we were talking with the premium members over the weekend, market trend model turned bearish. That's really the third time since the April low that we've seen that. The last two times the short-term model has turned negative. It's only been negative for about a week. We've had a pretty significant bounce soon after that turned the short-term model back positive. We'll have to see if that happens on the shortened holiday week here. But for now, really indicating the weakness that that was created in the market conditions last week. All right, Magnificent Seven and friends, some juicy up days with some of these stocks. Broadcom, as you can see, up 11%. That's probably, arguably, out of this basket of stocks, I mean, probably the most impressive recovery so far this week. Tesla bouncing higher. That one's still below its 50-day moving average, if I remember correctly, but up about 7% today. Alphabet, I mean, not even close. Alphabet's by far the strongest chart of this bunch. I did grab that just to show you the consistency of the uptrend, but I feel like a lot of people think that all the Magnificent Seven stocks look like Alphabet right now because that's what it kind of feels like, or that's what you want it to look like. But Alphabet's the only one that's still making higher highs and higher lows, clearly above the moving averages, up another 6% today. On the downside, Microsoft is the worst performer, still up 0.4%. Apple up 1.6%. Microsoft's a tough one. That's one that, testing the 200-day moving average. Amazon and Microsoft both testing the 200-day. Now, by the way, I'm thinking about these names because a couple hours ago I posted a video to the Stock Charts TV YouTube channel. That's my weekly show on Stock Charts TV. Dug into each of these 9 charts and talked about key levels. Really grouped them into 4 different buckets. I talked about some key ways to approach each of those buckets. I would encourage you to check out that show on the Stock Charts TV YouTube channel. All right, let's look at the market carpet. This is a heat map. I love visualizations like this that allow you to go macro to micro, broad to more specific. And let's talk about some of the takeaways. Obviously, for me, the strength in the biggest names is number one. Obviously, in the lower left, you've got the 3 big communication services stocks, Alphabet, Meta, and Netflix, all up pretty good today. Alphabet, of course, up 6%. That's one of the biggest names and certainly one of the biggest moves. Right in the middle, you have Amazon and Tesla, the 2 largest consumer discretionary stocks in the green. That's helping. In the upper left, we've got NVIDIA, Apple, Broadcom, and a bunch of the semiconductor names like Micron and LRCX and Applied Materials and AMD and KLAC and all of those with really good up days. So the semiconductor trade, which has been underperforming big time in November, having a nice bounce today. The question is that a dead cat bounce? Is that a brief recovery after last week's bloodbath? Or is this the beginning of a broader recovery? The good news is I think the charts will tell you that. I don't think you have to be that far ahead of this. I think a lot of times as investors, we get so desperate, like we're afraid to miss one day, and that causes us to make really rash decisions. I think if you use charting correctly, if you use technical analysis correctly, you don't have to be in a panic when you're looking at charts. You just have to look at them, gather the evidence, go with good charts, stay away from bad charts, and just do that consistently. And the consistency is the problem for people. It's not having the perfect indicator or the perfect approach. It's inconsistent practices, right? It's doing a really good thing, but not doing it often enough or consistently enough or the same way. That's how we're going to do. We're going to do quite well. So obviously a nice recovery day. And again, I think what's going to happen is tomorrow is going to be pretty meaningful. Wednesday and Friday are most likely very light volume days with probably slightly higher would be the general playbook around the Thanksgiving holiday. This is kind of a throwaway week as tough as that is, because I feel like we're all waiting for a key message. There's not a lot of economic data, not a lot of earnings data. This is kind of a quiet week, so it's going to be lighter volume and generally drifting higher. That's probably what's going to happen. First week in December is going to be a pretty meaningful one. So if you're taking a break this week, I don't blame you. I'm going to try to take some time off for sure. which as an entrepreneur is never easy. But next week is we'll get back to it. We'll sharpen up the pencils, get ready to go, and get back to some heavy charting. I think that's when we could have that next big move. What's interesting, by the way, today when we're looking at it outside, and communication services outside of the big three kind of internet names, kind of all red. If you look at consumer discretionary, outside of Amazon and Tesla, those first two names, you've got random other things like Ralph Lauren, Wynn Resorts having up days, Booking.com bouncing off of a swing low. But the rest of this is a pretty ugly day for consumer discretionary. So this is kind of the issue I'm having with this particular trading day. Outside of technology, it's like the big stuff did fine, but the smaller names within the S&P kind of underwhelming. And hey, Merck traded above $100 a share today. Healthcare, I mean, my daily broken record announcement is going to be pointing out charts like Merck and Eli Lilly. Healthcare continues to be just one of the most impressive sectors. If you're frustrated with technology, just whipping up and whipping down with these big percentage swings, a lot of healthcare charts are these nice, consistent uptrends, really improving on a relative basis. Those are the kind of things I love to have in a portfolio. A little lower noise, and hopefully some good opportunities as those things continue to work. Delta Airlines is kind of an interesting chart. I mean, and this is when I think about what's happening with the market right now. There's no denying there's been a change of character. I think that's fact, not opinion. In November, things have changed so much. So many things, as we've covered deeply on the show, particularly leadership rotation. The way out of this sort of change of character is good charts start to emerge. And that's why Alphabet is still a very strong chart, because it's still going up, right? While other charts within the Magnificent Seven are not going up, or are sort of treading water. They're stuck in a range of some sort. Delta right now is a sideways trend, right? And so I think of a chart like Delta as a sit on your hands and wait kind of chart. It's not in an uptrend. That was back here in May, June, July, higher highs and higher lows. And it's now in a downtrend. That was February and March, lower lows and lower highs. The moving averages are flat. There's clear resistance around 62. There's clear support around 56. This is not the type of name I would be super aggressive with until and unless we break out of this range. Also look at the momentum, right? Good lesson here on an indicator like RSI. When the trend is bullish, the RSI goes up, and you have the price. The RSI becomes overbought on upswings, and the RSI doesn't go much below 40 on pullbacks. In a distribution phase like March and April, the RSI becomes oversold on sell-offs and doesn't get much above 60. In this case, it didn't even get above 30, 40, or 50 much during that downtrend. So the whole range of the RSI changes. In a sideways tape, right, where we're more range bound, the RSI remains between 40 and 60. What this tells you, the way this indicator is calculated, is based on up days and down days. So if you have a chart where there's just up days and down days, but they're pretty even, and there's no real, one side or the other, accumulation, distribution, buyers and sellers, neither side is really taking control. It's more in an equilibrium. The momentum is neutral. So the RSI is just fluctuating around 50. So what you look for is a break out above 62 with the RSI pushing above 60 on heavier volume, or a break below 56. The RSI breaks below 40 on heavier volume. A breakout with momentum support on heavier volume. That's what I'm looking for on Delta. Until then, it's telling you it's just not a great option. Now, if you trade options, and I would encourage you, if you don't, or if you do, I interviewed Alan Ellman for the Market Misbehavior podcast last week. Alan's an options expert. He's written a ton of books on different option strategies and has some really good thoughts about some ideas about how to incorporate options in an environment of instability, which is how we agreed we are in right now. Using plenty of option structures, you can make plenty of money when a market is range bound. You can bet on Delta remaining within that range. Use straddles and options plays like that to more play of a range bound chart. But as a long only investor, for me, this is a chart without a catalyst. So I'm happy the chart telling me when it's the right time to get in. I'm not getting that yet. All right, we're going to continue on in a moment. I do want to give a quick shout out to longtime supporter of the channel, Seeking Alpha. If you go to marketmisbehavior.com/alpha picks, you will see their Black Friday sale, 20% off alpha picks. This is where they use their quantitative models and hand select one or two every month to dive deeper into the fundamentals, the technicals, paint the whole picture. And I think I'm a big fan of their quant model because I think it uses really good techniques and approaches that I have used at large institutions many years ago. And I think having that capability as an individual investor just puts you ahead of others. So check it out at marketmisbehavior.com/alphapix. If you use my code, you get a great deal. You can also help make market misbehavior awesome. QR code you can scan on the screen there will get you more information as well. Let's finish off the show looking at some charts together. As always, if anything I'm showing brings a question to your mind, please take a moment, put a comment below our YouTube video with your question. We'll plan another mailbag episode at some point. Maybe I'll crank it out on Friday. We'll see how things are at. All right. Looking at the daily chart of the S&P 500, we've talked for quite some time about our line in the sand at 65.50. So again, we have not broken the line in the sand yet. And I think that's pretty important. The value of setting a line in the sand is you agree that if the price is above there, just things aren't that bad. And that's sort of where I'm at with this. I can tell you a lot of reasons why I think the market could go a lot lower than this. If you ask me to pick, do I think the market's going to go materially higher and materially lower first? I probably guess materially lower because of a lot of the things we've talked about on the show. But have we gotten that validation with a breakdown of support? We have not. And because charts like Alphabet remain so strong, because Alphabet is a hair's breadth away from previous all-time highs, the S&P and the Nasdaq are holding above support quite well. It also means if and when we break below 65.50, for me, that unlocks another downside target. The 200-day moving average, I think, in this sort of a pattern makes a ton of sense as an initial downside target after a break of 65.50. But for now, it's holding. Also watching a trend line based on the previous highs. I think getting back above that trend line would be a really encouraging way of wrapping up this pullback phase, but we'll see. Nasdaq 100 bullish percent index just touched the 30 level last week. I was looking at this a little bit more over the weekend. What's funny is what happened here last week, we got right down to 30%. This is the Nasdaq 100 bullish percent index. This is a breadth indicator based on point and figure charts. It's what percent of the Nasdaq 100 stocks are currently showing a buy signal or a bullish signal on their point and figure chart. It's down to 30%, down from around 85% in mid-May. So we can see how many stocks within the Nasdaq 100 have had breakdowns, right? Valid breakdowns. But we've touched this 30% level a couple times. And most recently, if you look back in the last 12 months, we've got this time right in March of 2025. And then this other one in August of 2024. So if we look at what happened here, right, this was after a pretty good sell-off, right? And you could argue we're kind of in a similar move off of the high down to where we were last week, kind of similar from that first leg down February to a March low. So if we're in this kind of period, you can see what happened with the bullish percent index was it got up to around 60%, and then that was it. And then, getting back below 50% after that was a really negative sign, I would say, for the bullish percent index. And so the fact that we did that basically signaled this is a short-term bounce. We've got a lot further of a sell-off into that April low. Now compare that to August, where we never made a new low. Right after the indicator touched 30%. It immediately accelerated, right? And so this recovery here off of August 2024's low was driven by a bunch of NASDAQ 100 members breaking out and even the indicator getting above 70%. So we didn't get that here. We didn't get up to 70%, which is usually a sign of most things are going up. And so this kind of surge would be a very bullish outcome to look for here. This kind of pattern where we kind of, falter before we get back up to 70% would be a really negative sign, similar to what we saw there in March. So if this ends up being an ABC correction, similar to what we saw in February, March, April of 2025, sort of a you are here moment, we can see the difference between the bullish percent index sort of sputtering around 60% versus the bullish percent index getting all the way above 70%. I think this chart might be an interesting one to watch to see if there's a critical mass of leading growth names breaking out enough. Their point and figure chart would have to give a buy signal to move that bullish percent index up. I think that's what it would take to have a meaningful recovery like we saw in 2024. Bitcoin, for what it's worth, bouncing off of support, almost got to 80,000, not quite to that big round number, but very, very close. As you can see, we basically made it down to the range February, March, April lows. That was sort of in that 75 to 80,000 range. So we sort of bottomed out just above that support range that we had talked about. The RSI had been oversold and then bounced higher. You know, for me, this seems like just a bounce higher before another leg lower. I'm going to assume that this trend is in a downtrend, or this chart's in a downtrend until further notice. But I mean, I think what are the kind of things that would tell me otherwise? Look at what happened back here in March and April of 2025 when we had a similar sort of drawdown. We then broke out. In this case, we broke above the 200-day. But look at the momentum, right? The RSI got back above 60, and that was a really bullish sign. The fact that we were breaking out to a new swing high on stronger momentum. And that's how far we'd have to go to really give that sort of all clear. So I would argue that chart probably has more work to be done, unless it's a crazy V bottom, unlike something we've seen in Bitcoin for quite some time. Here's a chart of gold. For now, the GLD holding well above the 50-day moving average, holding well above that Fibonacci support level around 360. I think the chart of gold overall is in a positive structure. Our market trend model, pretty constructive based on the medium-term and long-term trends. The momentum has remained quite strong for pretty much the entirety of 2025. I get nervous when that's no longer the case, but for now, uptrend, higher highs would be ideal. Getting above 387 on a rally would be pretty encouraging there. I mentioned the video on Stock Charts TV. Again, I would encourage you to check that out if you want more detail on what I'm about to tell you. But while Alphabet is clearly the positive outlier, breaking to new all-time highs again this week, I'm looking at 4 trillion market cap company Apple right here, which is basically sideways. We've had a number of pullbacks since August, or since the end of July, really, for Apple. We've pulled back to the 21-day EMA. We have soon recovered. In this case, we've had a little more of a time correction than a price correction since making that high in October around 277, 278. We've sort of been in a sideways trend here. And I think getting out of this range to the upside would obviously be a pretty good follow through. That would be only the second of the Magnificent Seven and Friends charts to actually make a new all-time high here in November, I believe. So getting that follow through would be pretty meaningful. Definitely going to be watching the momentum as well to see if we can break out on stronger momentum. Now, the reason why the S&P and the Nasdaq are not up way more is because you have 1.3 trillion market cap company Meta, which is in a primary downtrend, well below moving averages, which are all above the current price level. We're bouncing today, which is not a bad sign. I think of a chart like this as sort of a stoplight, right? We gapped below the 200-day. This was on earnings at the end of October. That gap also took us below the first Fibonacci support level, which for me says expect the next downside objective at the 61.8% level. Look at that hammer candle we had right as we tested that support level around 600. This was the first week in November. We bounced for just one day and then continued lower. And last week, we spent most of the week below 600. I think of a chart like this as a stoplight. Below 600 is bearish. That means we're in a period of distribution, continuing that pattern of lower highs and lower lows. Between 600 and we'll call it 675, I think we're neutral. I think we're between that Fibonacci level and this one up here, which is also the 200-day moving average. But if we can break back above the 200-day, that would also clear Fibonacci resistance. That would also clear that lower end of the gap. We can get above there. This all of a sudden becomes a very constructive chart. That's why it's a green light. So I think the traffic light approach with a chart like this makes a ton of sense, built on Fibonacci levels, built on previous support and resistance, built on moving averages, but using it as sort of a general playbook on how to think about, sort of a framework to think about what's going on. 2 more charts, I think, to share with you, maybe 3. Here's a chart of NVIDIA, right? Before you get too bowled up after today, and again, plenty of stocks went up quite a bit today, and I totally get it. But that's pretty common. Some of the biggest up days you'll ever see are in bear markets. I will tell you that from a lot of experience with these. But I will tell you one concerning note is that NVIDIA is still nowhere near where it was when it reported earnings, and definitely nowhere near where it was after earnings were reported. Stock gapped up to around 196, and that was it. We sold off a little bit more on Friday, and today, which was an update, 2% higher. That's not a bad thing, right? That's good, but we're still not even recovering back to the optimism that we saw post earnings. So the chart of NVIDIA still testing support at best, right? I mean, we're still testing these swing lows around 178 to 180. A break below there, 165 will be the first Fibonacci support level. The 200-day is a little bit lower, around 153. So I think this is still an open question. I'm not willing to say NVIDIA has a super constructive pattern just yet, particularly after the earnings win and the distribution that is still, I think, the story on that chart. You know, Lam Research is one of the many semiconductor names up quite a bit today. LRCX was up over 5%. You know, again, all semiconductors generally moved higher today. We take the major low in April. We take the major low at the beginning of September. You can see that currently comes in around 125 or so. Trend lines like this are really helpful on just a big uptrend, just as a gut check, because this trend line on a log scale chart represents a consistent percentage run rate over time. And so that's your sort of your rate of return over time, consistent slope on the trend line, which means any break of that would tell you something is different. Now, the last time we had a time correction in July and August, we eventually broke out. Stronger momentum, but a nice break to a new 3-month high. And so that's why I think a break above 165, this is a time correction. That's the room you have before you really need to start breaking above 165 on stronger momentum. For now, the chart's okay. Getting back above the 50-day moving average, I think pretty encouraging, but that would be the sign of a real, you know, upside breakout. Until then, I think it's still consolidating more than anything else. Yeah, I was going to say, I thought I grabbed a chart making new 3-month highs. So I ran a scan, as always, of stocks making new 3-month highs and 3-month lows. I would encourage you to do that routine when you can. It's a great way to just keep on top of things that are on the move. A lot of clothing names look pretty good. Here's RL, Polo Ralph Lauren. And if you look, making a new all-time high today, closed just around 350, and that break above 340 today was pretty good. Over the last 4 weeks, we'd hit 340, pulled back to the 50-day, retested 340, pulled back to the 50-day. Finally today, completing that breakout as the RSI pushes a little above 60. I think this is a, you know, charts like this, very alphabet-like, right? Sort of primary uptrends. And this is not in technology. It's in clothing, right? It's a clothing retailer. So going into the Black Friday season, we'll see if that's a part of the story. But from a technical perspective, strong charts are worth paying attention to. Folks, we'll call it a show. Thanks so much for tuning in here on Monday, November 24th. Thanks, as always, for supporting me and Market Misbehavior. I appreciate you tuning in. Please take a moment and ask a question. Any of the charts that I showed you, anything that I didn't show you, tickers or indicators that you're thinking about, let me know. And in our next mailbag episode, hopefully we'll feature one of your questions on the show. In the meantime, have a great night. And remember, it's always a good time to own good charts. Take care, folks.